AIG was a classic insurance company which did very, very simple insurance policies, particularly reinsurance or insuring life and so forth. Very known businesses with very known risk profiles, and they were a very good company and grew very quickly. What happened was, in the late 80s, a bunch of people who were in derivatives moved across to insurance companies. And actually, AIG wasn't the first. The first was actually Prudential. Prudential Insurance, because both all these companies were very highly rated, had very good balance sheets and very good credit ratings, so they could do lots of transactions, particularly long-dated transactions, attracted this talent from the banks. And the banks came in and essentially said, look, you've got these wonderful balance sheets. We can use your balance sheet to do this type of business. And to some extent, derivatives, because as I think I earlier said, has an insurance component, was something that the insurance shareholders and management could relate to. They said, look, this is not very different from our underlying business. What we're really doing is providing financial insurance to some degree. So they had sort of fit. The problem was then these people came into these organizations and used balance sheets, which in the case of AIG was a very good balance sheet, AAA rated, and then they started to do other business. And what actually happened in AIG is very typical. It's happened a couple of times. It's happened at Prudential. It's happened at Gen Re. So AIG is not the first story. So what happened is they built this small business initially, which sat off left of center. But gradually what happened is this business became more and more toxic in the sense it became a very big profit contributor to the business. And in the world of just business generally, you're expected to keep growing your earnings at a certain rate. So effectively what then happened was these people wanted to find ways of actually growing their business. So that derivative business effectively grew more and more and became a disproportionately large portion of the business. The other thing is what they did is actually quite fascinating. In the case of AIG, they got into an area which is actually effectively credit insurance, which is basically the area of credit derivatives. And that seemed a very good fit. And what they did was insure what they considered to be very highly rated, so very low risk transactions, and they got tiny margins for that. The problem with that is not that they got paid tiny margins. They should have got paid tiny margins for effectively the risk, which was very low. However, the whole game that AIG was playing depended on them remaining a AAA rated company. Because when they entered into contract, one of the reasons you used AIG to hedge yourself is because it had such a high credit rating, and so you could count on them to perform under the contract under pretty much all conditions, because obviously you assume that a AAA will be the last to default under any circumstances. But what happened was AIG started to take some losses, and these losses were based not on actual losses, but the fact that the market valuation of these insurance contracts changed. So under those circumstances, if you had to close out your position today, you had what we call mark-to-market losses. Now, those mark-to-market losses resulted in their rating coming down. And what was not very well understood by people outside the industry is when AIG did these contracts, these derivative contracts, there was a clause in the contract. And the clause said, look, you're AAA today, but we are dealing with you for say 10 years or 15 years or 20 years or 30 years. You mightn't be AAA in the future. So how do we know you're going to be there? So what we did in those contracts was put in a clause. It's a tiny innocuous clause which says, okay, if you get downgraded below a certain level, which you usually did AA minus, so you got downgraded below that level, we're concerned about whether you can perform under the contract. So how do we make sure of that? You lodge collateral. In other words, you give us security in the form of cash. So you say, if that contract is worth X today, you give us that amount. And AIG found itself in the position in October 2008 when they were going to be downgraded below AA minus. And effectively at that point in time, they were going to have to come up with somewhere north of $10 billion. In fact, the amount I think in the end was worked out at around $14 billion. So AIG's problem was not specifically related to the risk. And to this day, there are people at AIG with some justification who say that they're never going to lose a dime on any of these contracts because they will never actually lose money on them. However, on the other side, the problem is, irrespective of whether they're going to lose money or not, they have to come up with this $10 billion or $14 billion to pay across the counterparties. And no company, even a company as large as AIG, can suddenly at the drop of a hat come up with that amount of money. So they ended up being caught in a liquidity squeeze. So it was less a risk problem. It may be a risk problem, which we don't know, but it was the liquidity problem which crystallized that problem. And then what it sets off is this chain effect. Because essentially there's this insurance chain, And what the Federal Reserve Board and the US Treasury were faced with doing is assessing a major, major issue, which is if AIG failed and it's a major part of the financial system, then what happens to that chain of risk where JP Morgan may have hedged with AIG, which is hedged with Bear Stearns, which is hedged with Lehman's, which is hedged with Deutsche Bank. If one point in the chain breaks down, what happens then? And they found themselves in this invidious position of having to decide whether to bail out AIG or not. And essentially they chose, particularly after the events with Lehman's and the disruption in the market, that they had to bail them out. So you've got to be very careful. In the case of AIG, there's a common misconception that the problem came about because of their losses. And we really still don't know whether on these contracts they're going to actually have losses. They may, but we don't know. But it was the cash requirement that triggered the problem for AIG. But it's also a very interesting case of a small group of people, because the number of people involved in this were quite small compared to the rest of their business. And this is one of the beautiful things about financial services generally in derivatives. You get huge leverage. You get a bunch of small people who can do very large transactions, so you can disproportionately contribute to the revenues of a company. And that's what happened at AIG, in my view. I think the best place to start in looking effectively at the role of derivatives is to take the credit space, which is credit generally, what happened. Now, the key instrument here is what we call the credit default swap contract. Now, there's a lot of mystique about these contracts, but in the end, they're credit insurance. So you might have had a bank which essentially has a loan to a company, and for some reason it wants to insure that loan to prevent themselves from suffering loss if the company fails to pay. So what they would effectively do is go and find somebody else who wants to actually take that risk, and they would reinsure themselves. Now, in insurance, you can only insure something you own. Now, and the transaction that we've just described is one of those. You have the loan, you're insuring it. But once you have derivatives in play, and credit is just one area, you can do any number of transactions, irrespective of whether you actually have the risk. So one way to look at the analogy is, let's say you and I own property. I own a house. I can only insure that house once. The derivatives universe essentially enables anybody to actually insure that house. So you could insure that, somebody else could do that, so 50 people might insure my house. So what happens is, if my house burns down, now the number of losses in the system becomes proportionately larger, because it's not only I who have lost and therefore the insurer has to pay me, everybody who is insured has to pay out. So what happened in the system is we used derivatives essentially to amplify the losses. And I'll give you a very good example, a concrete example of that. When Lehman Brothers failed, Lehman Brothers had roughly $600 billion of debt on their balance sheet. So if you'd lent money to Lehman Brothers, clearly you lost a very large chunk of that. Now, many of those lenders had reinsured their debt in the market. Now, the total outstandings of credit default swaps as a form of credit insurance was roughly roundabout, as best as we can work out, roundabout $500 billion, maybe somewhere between 300 and 500 of this, we can work it out. Now, the problem was not all of those credit insurance contracts were taken out by people who had lent money to Lehman's. Some were taken out by separate people. Now, for the people who had lent to Lehman's and used these credit insurance, it just transferred the loss to somebody else. So you as a lender didn't lose. That loss was transferred to the insurer. But the other people who had effectively, I suppose, done these transactions quite independently suffered losses or gains on the other side as a result of Lehman's default. And that actually amplified the losses in case of Lehman's by as much as 50%. So the total losses weren't 600 now, they were 900. So one of the roles that derivatives played was they essentially amplified losses through the system because of the speculative transactions which had been done. Now, this is only in credit, but then what happens is obviously other things start to move, like equity prices come down, interest rates become more volatile, currencies start to move, where the same multiplier effect now permeates through the global economy and triggers ever larger losses. Well, it's actually quite fascinating. I used to run these courses in derivatives and structured products and so forth in London. And I found in the late 1990s and early 2000s quite a curious phenomenon. I had not met anybody from Icelandic banks, but they started to come. They usually came in ones initially, then there were twos, then there were threes, then there was 5 of them in each of these courses. And the courses are quite small, so they would make up a significant part of the attendance. And I went up to one of them and asked them, I said, why are so many people from Iceland attending these courses? And they said, well, we've got this vibrant financial system. So I started to do some research into Iceland, discovered there were 300,000 people. And half of them seemed to have attended my course. And I said, well, is there anything other than effectively a financial economy? And then I started to look at how much they'd borrowed, how large their banks were, and certain alarm bells started to sound in my head. So basically, these people had forgotten what they were, which is primarily a cod fishing, geothermal, creating, aluminium smelting economy. And they'd become a completely financial economy where borrowing money from overseas and investing that was almost the base of the economy, leading to rampant property speculation and all sorts of things, including the largest population of Range Rovers I've ever seen. It happened to be in Iceland. And increasingly, they're now known as a different name. They're no longer known as Range Rovers. They're known as Game Overs. And so the whole dynamic of the economy changed through financial activities, including obviously derivatives, which was actually quite an interesting experience in that sense.
And did you ask these people, what they thought and why they thought they could become this way overnight, and warn them, this is kind of like crazy?
I think I did ask them that question. The answer was always very vague. I think people often confuse modernity and being part of the developed economies of the world with certain attributes, which might be Louis Vuitton bags or might be a trading in sophisticated financial instruments. And certainly in these cases, these people thought a vibrant financial system, which was very sophisticated, was part of being a modern economy. And they saw this as a driver of their economy. They didn't see finance as a secondary supporting function. They saw this as the core of the economy, which kind of intrigued me and disturbed me quite a bit, because I certainly don't think that finance should lie at the heart of an economy. It's a subsidiary function, not a primary driving function.
You still work for, consult to, deal with, talk to a lot of bankers. And a lot of people who invented these products and trade them and so on. What do they say about the damage that these things have done? What do they say about the crisis? What do they say about their own responsibility?
I think you've got to look at these people as almost a group of people who are very clever, who invent these products, often without a deep understanding of effectively the effect the products have. They don't think outside their domain knowledge in terms of how you design this, how you trade it, how you sell it. They don't think outside that. And this business has such high rewards. It attracts people who are very highly driven, very highly focused people. So these people have never really, in the main, and there would be exceptions obviously, who think outside that. And these people are often remarkably narrowly focused in their lives on certain things. And I can always tell you that there are two aspects of their lives. One is they trade or do whatever they do for a living, and the other part of their life is how they spend what they get. Beyond that, the whole world as it exists, they live a fairly cocooned existence, doesn't exist. And so it's only very recently they've started to see that there is a secondary effect of these particular products that they do. And to some extent, it's coming about because banking as a profession, what they do, has been called into question in the crisis. But beyond that, they have no real views on that. And to some extent, they are a little surprised that what they're doing is suddenly so much at the center of attention. And I think their major concern is how they protect their professional franchises if they're still in the business. If they've made their money and got out, well, as far as they're concerned, winners can be grinners and, losers can please themselves. So under those circumstances, there's not a lot of reflection in this industry, which is one of the problems, is people often in this industry don't understand what goes on. And fundamentally, I would say that's another change that I noticed. When I started in banking, bankers were kind of different. They were very rounded. They weren't necessarily focused on very narrow things. And they had a connection to the real world. But these people who live with their computers, with their screens, almost essentially live in a surreal world where the actual implications of their actions are so remote to them that they don't actually register in their way of thinking. So I don't think there's been any change. And in fact, one of the most interesting things is that in my conversation the last 12 months or so, people have said to me, what's the problem? Things will just go back to what they used to be, won't they? And my reaction has been, that might be the case, but just talking to ordinary people whose lives have changed forever, whose jobs have gone, whose savings have been wiped out because they're with a bank which can't pay them back, or alternatively, their pension funds have wiped out half their savings and they're looking forward to a retirement which looks fundamentally different to what it used to be. I don't think they share your view that things are back to normal. They have a quite different view.